Thank you so much, Maran sir, for the time on your calendar. So to begin with today's discussion, so the first question is from Rikin. Rikin is our alumni. He's presently working with Omkara Capital with Varinder sir. Rikin, maybe you can proceed further with your question.
Hi, sir. Good evening to you.
Yes, Rikin.
So I've been an avid listener to most of your sessions, and in one of them you mentioned about cycles and small cap, large cap, and mid cap, and how they diverge during bear markets and they converge during bull markets. So when you had taken that session, that time they were perfectly meeting each other, and then we have seen the rally ever since. So at this point of time they're all below their October peaks. So going forward, how would you think of these? Would you expect history to repeat going forward? Like how would you make sense of this data now?
Yeah. There are two things to bear in mind when we use these graphs. First is, we should be conscious that these indices composition change time to time. Sometimes a stock which runs up sharply and as a result of which come into the top 500, therefore come into small cap index after a big rally. Similarly, a stock which is between 250 to 500 because of sharp upside movement becomes a mid cap, which is 100 to 250 and comes into the mid cap index. And if the index did not have any restructuring, any change, then this graph would have looked slightly different. And these changes are not at constant intervals. Sometimes in a year, you may find 2-3 material changes. Sometimes in 2-3 years, you don't see any material changes. And therefore, making short period inferences based on this graph may be misleading. But it gives you what? It gives you an empirical evidence that in a rising market, mid caps rise more than large, and in a falling market, they tend to fall more. Now, price has two variables, right? Earnings and PE multiple. So, in a rising market, small caps rise more, either because earnings of the small caps rise more in a rising environment, or maybe PE multiple of small caps rise more. Exactly on the reverse side also. In a falling market, the prices of small cap indices decline a lot, maybe because earnings of small caps struggle in tough environments, or PE multiples of small caps decline sharply in tough environments. Both can happen. So these two we should bear in mind. But where we use this graph practically is, before I explain where we use, also I'm assuming that you already know that large cap has only 100 companies, mid cap has 150 companies, small caps has 250 companies. But when you talk to investors as well as fund managers, they look at these three as separate islands of opportunities. Many often, I'm sure you may come across your own clients, your own friends, saying, should we sell mid cap, should we buy large caps, or should we increase small caps and decrease? That kind of choices, like you have in US and Europe and many other countries, in India, you have those kind of choices only in few businesses, like financial services, IT, maybe pharmaceutical. where you have large caps, you have mid caps, you have small caps. Sometimes small cap IT is cheap, sometimes large cap IT is expensive. So you can make that segmental choices. But let's say tomorrow you want to invest in insurance industry. There's no small cap there. There's no mid cap, only large cap. But on the other hand, you want to invest in footwear industry. There's no large cap. You have only mid caps. You want to invest in building materials like plywoods, lamination, tiles. You don't even have mid caps. You have small caps. You want to invest in your industry or our industry, wealth management industry. There's no mid cap. Largest wealth management company, IAFL Wealth, is a small cap. So the choices we need to make in our portfolio is a function of the businesses we choose to invest, right? But if the business we choose to invest doesn't have choices, then how do we make choices of the portfolio based on these three lines? Right? But where we should use this is, for example, if you take 2018, where is 2018? Look at January 2018 and December 2018. What you will find, large caps rising, small mid caps falling. Correct? Do you find that? So it happened, which never it happened before. It happened never later. Why? Because that year, January, SEBI came with the mutual fund restructuring regulations, whereby they said first 100 companies are large caps, next 150 mid caps, next 250 small caps, and then told every mutual fund, you have to define your benchmark for every scheme. And once you define your benchmark, 80% of the composition has to be from that universe. So you can't call a fund as a large cap fund and have many small mid caps. You can have 20% small mid caps, but 80% has to be from this universe. So that made many mutual funds in 2018 to sell small mid caps and buy large caps, not because they felt that's the right thing to do, but because they have to comply. So they were selling small mid caps because they have to sell, and they have to sell before 31st December. So is that an opportunity? Fantastic opportunity. No? If someone had seen this graph, and if you are in December 2018, what proportion of your portfolio should be in large cap? 0. What percentage of portfolio should have been small mid cap? 100%. Now come to September 21. Where is September 21? Yeah.
September 21.
September 21, correct? In September 21, two things happened. One, the number of IPOs in India hit all-time high. And number of companies, insiders increased stake, hit 12-year low. 12-year low in September 20. Both tells you what? Both tells you that people are happy to dilute. Right? Promoters are happy to dilute. They're not keen to increase. This is one sign. The second sign, the incremental flow. We discussed small caps rising either because earnings are rising or PE multiples rising. So if you look at the small cap rise, which one was driving that rise? Earnings or PE? PE multiple was driving it, not earnings. So what should you do? If you are not benchmarked investor, you have freedom of making choices. You should be reducing small mid caps. Right? But this is only at the allocation level. That doesn't mean every small cap you should sell. That doesn't mean every large cap you should buy. But these graphs should be used more in the broader inferences, not in stock selection. It gives you warning signs. It gives you opportunity, green lights. It gives you when you should be even. So what we did in September 21 or during around that time is we have reduced small caps from 50, 60, 70% of certain portfolios to below 20, 30%. And we had never been in large caps in 2018, 19, 20. Today, 30, 40% of our portfolio is large caps. Okay. The final point in this is this chart captures only the price. Correct? This is only value. How index went up. Where is the volume in this? It's not there. And we are assuming volume is neutral. It is not. The large cap universe is 75% of India's market cap. Mid cap universe and small cap universe put together is only 20%. Out of that 20%, maybe 7-8% small caps, maybe 11-12% large mid caps. The price discovery mechanism in any asset class, in any country, is a function of the type of people who are in the price discovery process. Let's say you want to buy real estate in Chennai, and there are only 5 guys in Chennai who are selling real estate. Market will be skewed. But if you are buying real estate in Bombay or Delhi, and you have 50 different types of sellers, 50 different types of buyers, price discovery mechanism is little more mature. Right? So in large caps, you have 85% of FI investments in India are in large caps. More than 80% of mutual fund investments are in large caps. More than 85-90% of private insurance companies' portfolios are in large caps. And in large caps, maybe 70% of the top 5 portfolio managers are also in large caps. Large number of family offices, large portion of their portfolio is in large caps. Which means what? In large caps, you may find FIA selling, DA is buying. You may find a mutual fund selling, PMS buying. You may find some family offices selling, some family offices buying. But that's not the case in small and mid caps. So what it leads to, about a month back on a Thursday, markets fell 2,400 points, right? Do you remember? In one day it fell big.
Sure.
So what was 2,400 points in percentage terms? About 4% of Sensex. It declined 4% in one day. That day, how much small mid caps fell? You don't need statistical evidence. It would have fallen more than 4%, right? Some 5-6%. But how many of us noticed that day that when Sensex fell 2,400 points, all the Sensex stocks were trading. Some buyers, some sellers, someone bought, someone sold. There were price transactions happening. But that day, if you take total number of stocks listed in NSE, 1,940 stocks, 912 stocks had downward settlement. No buyer, only sellers. Because in large caps, when they fall 10%, you have seen 10% green line decline in the last few months, right? And the same time you found mid caps falling, small caps falling. But the small cap, mid cap volumes fell 70-80%. Large cap volume did not fall. Actually, large cap volume sometimes goes up in a fund. But small mid caps are not that. So if you are readjusting your portfolio, if you have to restructure your portfolio, how do you restructure portfolio in small mid caps at times like this? You cannot, because what you want to sell, you cannot sell. So people like us who manage large capital, relatively speaking, I'm still a small manager, but when it comes to small caps, I'm a large manager. So should I restructure on a fall or should I restructure on a rise? It's easy to restructure on a rise. So some of that, this graph won't capture, which is what I'm trying to help you understand. The graph should be used more in a directional inference, not in implementation. Today, looking at the graph, we should not decide we should buy small cap or big cap. But looking at the graph, it is clear that we are far away from convergence, which means we should not be overly into smaller mid-cap stock. Because the pain, if it continues, you can't restructure if you buy. So what you buy is something you know
Won't
you
be able
want
to
to
sell.
change your mind for some time. That's one. I don't know whether you have the other graph which you always use in divergences within large cap, mid cap, small caps. If you allow me to share, I can share my
Yes,
screen.
of course, sir.
And maybe because this is a topic and we already have discussed 70-80%, the last 20%, if we discuss in the same
Yes,
topic,
yes. So it would be very helpful.
clarity, lot of clarity. Can you enable me to share my screen?
Oh, so sorry. Yeah. Yes, sir.
So this is what I meant. And if you see the promoter buying, where is September 21? This is September 20. Do you see the number of companies promoters buying has reduced a lot? The bar to be seen with the left-hand side, number of companies, promoter board, and yellow line is mid-cap index. So when index went up a lot, it's huge drop. This line that you see, you didn't see since 2007, right? Now, this is what I wanted to, it may take only 2-3 minutes, but it may need some attention. So this we prepared last month and we took last 3 years. Last 3 years, we have seen a fall and a rise. So if you take February 19 to February 22, and we have this for January 19 to January 22, we have this for December 18 to December 21. So if you take over a 3-year stretch, it's very, very, very clear and it is consistent that the line graph is large cap index to be seen with the left-hand side y-axis. Each dot is each large cap stock's actual return in the last 3 years to be seen with the right-hand side y-axis. So what is the point we are trying to say is, had you invested 100 rupees 3 years back in Sensex or Nifty or any large cap index, that would have become 70 rupees by March 20. And now we built 150. So how much Sensex has gone up last 3 years? 50%. From the recent low, 70 has become 150. It looks like 120% growth in last 2 years. Effectively, last 3 years, how much Sensex and Nifty has gone up? 50%. During this period, how many of the large caps moved 50%? This is 50%. Hardly 20 large caps have moved 50% last 3 years. But 100 stock large cap index has moved 50%. Out of 100 stocks in large cap universe, which has moved 50% last 3 years, only 20 stocks moved 50%. There are 20 stocks which have gone up more than 150%. And there are 10 large cap whose prices today are lower than what they were 3 years back. Collection of all this is large cap index. Okay. You see divergence even within large cap index. When you see that in mid caps, this is mid caps. Optically, first thing that strikes your mind is number of dots diverging is lot more. Correct? There are 150 mid caps. So 100 rupees in mid cap index in February 19 has become 65 rupees by March 20, which means it fell more than large caps. And then it went to 165. It went up more than large cap index. But effectively, how much mid caps have done last 3 years? Same 50%. But during this period, how many mid caps went up 50%? This is 50. Hardly 20-30 mid caps. 1/3 of the mid cap index have gone up more than 150% in the same time. Now, this is small caps. Is there any pattern? Absolutely no pattern you find. So 100 rupees in small cap index in February 19, by March 20 broke below 60, then went to 200. 60 becoming 200 looks like a wonderful rally, but 100 has become 200. But during this period that 100 went to 200 and then fell to 170, How much small cap index has gone up? 70%. During this 3 years period that the small cap index went up 70%. How many small caps went up 70%? Maybe 100, 150, but more than 100 small caps are today lower than what they were 3 years back in absolute price. And there are 100 large caps which have gone up 3 times. Divergence is more. So you can't use the first graph that we used in building portfolios. But the first graph that you used gives you some kind of a directional indication of where do you look for opportunities and what is driving that growth. If small cap growth of 100 that became 60, becoming 200 is driven by PE expansions, then you need to be careful, right? And if large caps haven't moved, and within large caps, certain stocks have not moved, even though earnings have moved, maybe there you can consider somewhere. So when September 21, not only this graph showed, I showed another promoter inference data. So if you combine these two, you will get a fair idea that September 21 is not a time one should be aggressively allocating more small cap. And within small cap, that was not a time to spray and pray. There are certain times you can do that, right? You don't know which is really the best one. So you, instead of buying 4 or 5 best stocks, you buy 20 to capture some, which is what many mutual funds do. But September 21 certainly was not a time to do that. This is a time to be even more and more stock oriented than index oriented. But having said that, this is not, we are far away from convergence point. Convergence point is where we should use this graph to reconvince ourselves that almost all of our portfolio should be in small mid caps, because that's what is taking most of the brunt. But today, that's not, we are nowhere near that phase. Yes, sir.
Rikin, I have a follow-up question on that. Is it okay if I ask?
So please ask, sir.
Sir, so you said we can't use this graph to, obviously decide in which direction we should move. But let's say if we are in a mix of large, mid, and small, and there comes a point where you need to, let's say, shift buckets from mid and small towards large. How do you do that? Like, how much proportion, what method do you follow?
There's no method yet. There's no, the more and more you put method into it, sometimes you get trapped into that method. Your stock, as I mentioned, your selection should be driven by the businesses that you choose. Large cap should be an outcome of what you are doing. Not, you should not have a top-down decision. Okay, I'm going to be in large cap today. No. Here, what are we saying? The businesses that we are holding went up, and small cap index went up. And you look at this trend, most of the growth is coming from PE expansion. And when small cap index went up 200%, it is not that all stocks went up 200%. Some didn't move. For example, take broking industry. Take our own industry. All of you know Motilal, all of you know Edelweiss, all of you know ICICI Securities. So what has happened in the last 3 years, 4 years? Motilal stock today is half of where it was 4 years back. So Edelweiss stock is 40% of where it was 4 years back. And ICICI Securities 3 times of where it was 4 years back. So your inference of allocation to the sector should be driven by whether you are holding ICICI or whether you are holding Motilal. Similarly, within small cap, if you are holding specialty chemicals, which in 2018 were trading at the same level where they were in 2015. And even though earnings were growing, price did not in 18. And when market interest came in 20, many stocks went up 4x, 5x, earnings did not grow. Same 20-22% earning companies grew 25-26%. But even if you calculate 3 years of earnings not in the price, and next 2 years of earnings to get into the price, still 100 should have become 250. But many stocks 100 became 500 and 600 because PE multiple, which used to be 15, 18, 20, maybe 40, 50, 60. and therefore you cut down. But most of the specialty chemicals were small caps that became expensive. But if today some of the large IT names and large banking stocks are available close to book value, so I want to buy. So that's how we. So it is not a decision of selling small caps and buying large caps. It is a decision of selling specialty chemicals and buying large banks trading close to the book, which is cheap. And that will, when to implement these graphs will help you in reconfirming your decision. This graph should not be used to take an allocation decision of small cap versus mid cap versus large cap. This graph should be used to validate what otherwise valuations are pushing you.
Rikin, please move forward.
Thanks a lot, sir, for explaining it so well. So my second question is a little bit around macroeconomics. So now we are in a situation where there is persistent inflation in the system everywhere globally, and interest rates are rising and are expected to rise further. So from a portfolio construction standpoint, how do you make sense of such data, and how do you decide what kind of implication it means for your own portfolio?
See, macro is no doubt important, but how do we take a view on macro? See, if in a classroom, if you don't know the answer, which others know, then you should feel bad about it. If no one knows the answer and you also don't, why should we feel bad? So in macro, macro, one advantage in fund management industry is you can speak macro for endless hours without saying anything. But when you speak company earnings, only 5-10 minutes you can speak. After that, you yourself don't know what else to speak. Second, 3 months later, if someone had taken note of it or someone had recorded it, it will look very odd. Macro is not like that. Macro, 3 months later, you will speak some other macro. 6 months later, there will be another macro. So you can speak about macro without being accountable to it. But you can't speak about a company or a sector without being accountable. So which is the advantage of speaking macro for fund managers or people in the fund management industry? Because in macro, you can never be precise and you can never validate. One of my friend who is in the acquisitions team in Johnson & Johnson in US, in Johnson & Johnson, every presentation you make, okay, first 10 minutes should be recap of your previous presentation, whoever it is. So no fund manager goes to Johnson & Johnson, right? Because if you go there, they will first say, okay, last time when you came, what did you say? Please, can you spend 10 minutes? So that you do, and you look at most of the fund managers talk about COVID or pre-COVID or many other macros in the past. Half the time they're right, half the time they're wrong. And many times that has not been very helpful in stock selection. Second, sometimes we overgeneralize macros. That's the unfortunate part. See, for example, if is interest rate, inflation, will they have some impact on the companies we hold in the portfolio? They will, no doubt about that. The extent to which they may have an impact, maybe some of us are overestimating, some of us are underestimating, there will be some impact. But I don't have any method to know what is likely outcome. So if I'm not too convinced and there is a good chance I could go wrong, then I should be in certain kind of stocks where the impact will be less, right? But just because globally inflation is rising, just because globally interest rates are rising, doesn't mean it should happen in India. The impression people get that we are all highly integrated market and we are highly integrated economy. We are not. Who said we are integrated? For example, if you ask Indian entrepreneurs, in the last 10 years, which is the year with the highest interest cost you incurred, they will say 2013. That's the first year when globally rates went into negative zone. Okay. So if you take January 2008 and January 2013, 30-year G-Sec yields in US fell from 5 to below 2.5. Actually below 2. 30-year rates. 10-year rates proportionately fell. So what was 10-year G-Sec yield of India between 2008 and 13? They moved from 8 to 9.5. We had our own challenges in 2012-13 on capex. We had $40 billion of FCCBs which were outstanding since 2007. All came for maturity in 2012, and there was no FCCB market. And Indian corporates were not able to borrow globally. Those days we used to call about PIGS. Portugal, Italy, Greece, Spain, right? PAGS. So PAGS market was becoming a bad word. Emerging debt was a bad word. So Indian companies were not able to raise globally. So they were borrowing in rupee terms and paying back foreign currency debt. And that added to significant demand for capital. So rates went up. But in the last 3 years, the rates are falling in India because RBI cut the rates. RBI was cutting rates in 2014, 15, 16 also, but the rates didn't fall. Why in the last 2-3 years, home loan rates have fallen from 8.5 to, when first time SBI did 7.25, everyone thought it's a teaser rate. Now everyone is doing 6.5. Why? Because RBI reduced rate? No. Our rates are falling because demand for capital is declined and supply of capital has gone up. Right? In the last 3 years, today if you take SBI account balances are all-time high. Current account balances all-time high. Term deposit in banks all-time high. PMS industry, we're in a PMS industry. Take PMS industry, last 3 years AUM that they collected from investors is more than what they collected since SEBI gave permission to the first PMS manager in 1993. So 1993 to 2016, what PMS managers collected is what they collected last 4 years. That's not any different with mutual funds. The total money mutual funds have collected from 16 to 21 is more than what they collected previous 20 years. That's not any different with brokers. Total number of demat accounts that they opened last 3 years is more than what they opened previous 20 years. All this is coming from where? It is not coming from what Times of India is writing. Times of India wrote that these are all guys who are stuck at home, COVID, they have no other work. They're all opening trading accounts and buying and selling stocks. And once normalcy comes back, these people will go back to jobs and the activity in the market decline. If that is the case, we should have seen decline in activity, right? We actually saw increased activity. So where is it coming from? So it is not coming from bank deposits. It was not coming from other financial. So where is this money coming from? The money coming from place where it was not properly recorded. It is coming from money otherwise that has gone into gold. This is a money which otherwise would have gone into real estate. So supply of capital has gone up, clearly, right? Demand for capital during the same period, is it this demand same? No. Take S&P 500, like top BSE 500 companies today. Their debt today, in absolute terms, is lower, but in relative terms, it is 1.3 times EBITDA now. And it used to be 3.5 times EBITDA in 2016. So just in 5 years, that, and whatever capex you see, everyone says, PLI, capex, credit, corporate credit should grow. It's a foolish way because where is this capex happening? Determine how much capital is going to grow. For example, tomorrow you want to put up a spinning mill and you want to do 1,000 crore turnover. You have to put 800 crores in capex. But if you want to do specialty chemicals, same 1,000 crores. You don't need 800 crores capex. You can do it in 300, 400 crores. You want to do 1,000 crores turnover in a dairy industry. Say you make yogurt, curd. Do you need 100 crores turnover? You don't, because your asset turnover ratio is less than a month. You can do 1,000 crore turnover by putting a fixed asset less than that. So businesses will, the type of investments that goes in determine kind of demand for credit. So corporate credit is declining. I don't think the demand for capital will push our rates higher. But look at US, exactly ulta, right? Everyone looks at Google and Apple's balance sheet and say US companies are cash rich. If you take S&P 500, that debt today is 2.5, 3 times higher than where it was 5 years back. Who's the biggest buyer of equities in US? Not institutions. The biggest buyer of equities in the US are companies which did buybacks. And these buybacks were funded with leverage. So what I'm saying is, while the macros are important, there is no method to find them of any use in stock picking. They're not going to use in stock picking. Let's not focus too much at time. But what we should be aware of is macros of global markets are different than macros of us. And if you get a historical perspective, today, if I need to err on the wrong side, I would rather err on the side of interest rates going up, but instead of erring on interest rate falling, which means I think it is safer to assume that the Indian rates are not going to go up, even if global rates go. Indian inflation is not going to be troublesome, even if global it's. People give too much importance to oil and the impact of oil in inflation, like what happened 10 years back when oil price went to 120. When oil price went to $120 in 2008, our forex reserves was not even 300 billion. Now it is double of that. And our economy was just 1 trillion when we had 140 billion line item in oil. Today, the economy has grown in nominal terms more than double of that. And when FIS took $15 billion, the domestic household savings was not even half of that. Now, domestic household savings in equities is double of that. So FISL $18 billion and we still don't fall. So things change. And therefore, global inference on macros, they're important, but somehow I get a feeling we are giving disproportionately high amount of time to something which is less important. We should be focusing on where is the opportunity. If government tax collection is 43%, should we not ask the question, where is this 43% coming from? How can a country of such a large size grow tax at 43%? How do you, if you are a government of India, you should be asking that question, right? My tax collection should be going up, either my tax rate should be going up, which it hasn't, or taxable profit should have grown, which it hasn't. Then what is the only third way your tax collection can be higher is compliance. People who have not been paying taxes have to pay. That's it. Is there any other way tax collection of a country can grow? Tax rate is same. Taxable profit doesn't grow. So the only other way is people who earlier did not file tax returns are filing and paying. So are we not, why? That is very critical data item for us, right? But 90% of our attention is in global macros, not even 10% into something which is critically important for us to understand. If we get that understanding, that will help us probably 2-3 stock picks. Macros don't. Macros are good for allocations, which is wealth managers' question. For you and me who are into stock picking, it's not that relevant. Did I answer the question correctly?
Yeah, sir. I mean, thank you. I got a good perspective.
Thank you.
Thank you so much, sir, for the answer. We can move forward with the next question from Shivani. Shivani is our FinBridge student, just like Ahmed was. So Shivani, you can start with your question.
Very good evening, sir. It's a pleasure to talk to you.
Thank you. Thank you.
Actually, sir, I have 3 questions. I will start with my first question. Sir, I wanted to understand, how do you use the parameter of promoter holding activities, the way they buy or sell the stock, to evidence the market valuation of the company?
In the last 15 years, we have data from 2005. Every quarter, if you download the list of companies where promoters have increased stake, for example, 31st March got over this week. Before 21st April, all companies have to file shareholding pattern. And 21st April, you just download all the companies where promoters promoters increase stake. And you don't know whether it is large cap, mid cap, small cap. You don't know whether it's good company, bad company. All you know is here is the list of companies where promoters have increased stake. You log in Zerodha and buy all the stocks, 1 lakh rupees each. And you hold on 3 years and blindly sell. And the balance 90 days, you don't look at market. You do your regular day job, whatever job is. And then June quarter gets over. By 21st July, download the list of companies. You buy 1 lakh rupees each. Hold on 3 years and then blindly sell. Don't look at market next 90 days. You do your regular day job. If someone had just done that since 2005 till 2021, he would have made 23.7% CAGR. The nearest best performing benchmark is not even half of it. And no fund manager I know has done that. Unify could not do it. Why it is so easy but very difficult is you need to trust the system. Right? In March 2020, when COVID happened, markets fell 30%. Everyone became half MBBS and looking at global markets, COVID, vaccine, temperature, all that. How many of us ask the question, first, who is buying, who is selling? Out of top 500 companies, 94 companies promoters are buying. And everyone is shorting theater stocks, hotel stocks. But the biggest buyer of Indian hotels that month was chairman, then managing director, executive director, facilities manager. Everyone is buying. Are they not oblivious to what's happening? They were also reading newspapers. They were also watching same television channels. So they were buying. So what promoter activity gives you is certainly a great perspective where to look for idea. Because you had less time, you need to move forward, and you may have to do research, and you may have to do research on businesses where research reports may not be available. So you can't research 500 companies. So which 20, 30 companies you should look at? Promoter buying is a great filter to use. But I'm not buying Indian hotels because promoters bought. Out of this list, which I told you, 23.7, about there was 450 plus companies that came into the list in different time intervals. Maybe out of them, 11% of the companies would have given negative return, which means promoters bought. You bought after promoters bought. You held 3 years and then sold, still lost money. That would have been your experience in 11% of the cases. In about 14-15% of the cases, you would have made single-digit return, not in CAGR, actual single-digit over a 3-year period, even though you bought after the promoters bought. But in 70% of the test cases, your IRR would have been between 25 and 40. That makes up for it, which means when 93 promoters buy and you buy only 10, and that 10 comes under the 11% of the universe, your experience of tracking this would be bad. And if I buy 20 companies and that 20 is out of the 70% companies where performance IRR is great, my insider shadow portfolio will have 25 to 40% IRR, which is fortunately that case in insider shadow twice that we did in the past, and this time also, third time. So for us, this is only a screener. So which means we should not buy because promoter is buying, but promoter buying tells you where to look for ideas. Why we should ask the question, no? Why in 2020 first quarter, the sector with the highest promoter buying was metals, and no one was buying metals. In 2020 January, if you take previous 1 year, 3 year, 5 year return in metals was negative. And that's where promoter buying was the highest. And now we should be asking the question, no? Why in the last 3 weeks, Godrej, two brothers of Godrej, it's not yet evident, but there is some kind of disagreement, some kind of family settlements. But both of them are buying Godrej consumer products. The stock is down 30-40%. Today the price is lower than where it was 5 years back. So price is lower than 5 years back. FIS are sellers, mutual funds are sellers, and the promoters are buying. So then we should ask that question. No, I'm not saying you should go and buy Godrej, but because he's acting, you should look at it. Yes, ma'am.
Yes, sir. I really like the way you answered it. Sir, my second question is around, see, in foreign, we see that most of the management are having single digit holding, whereas in India, it's more than half. So will there be any shift in India also, the way it is in foreign, because of more of the people are participating in the markets?
You are correct, actually. It's more to do with legacy. It's also to do with, okay, I'll give you one data point. When war opened in Russia, Russian government closed the stock market. Russian stock markets were closed. Who felt very bad? Locals or outsiders? When Indian markets gets closed, who will feel very bad? A lot of us will feel bad, no? Markets are closed. I can't sell. When Russian markets closed, one question no one asked is, who is holding Russian stocks? 80% of the Russian stocks were held by FIIs. 80% of the free float of Russian equities are held by FIIs. Locals don't invest. So when Russian government closed the stock market, local Russians never felt the pain because they didn't own much equities. Similarly, in India, if you take before 1991, there was no IPO, there is no private equity, there is no venture capital, there is no private sector banks. So the principal form of financing, if you're an entrepreneur in 1970s, 80s, was to access debt. And those days, banks used to insist promoters to give personal guarantees, even if the company takes a loan. In India, now it is called bad governance. In 80s, 90s, it was a norm. So if you're Mukesh Ambani, you may own 45% of Reliance, but if Reliance is taking a 1,000 crore debt, SBI will take personal guarantee from Mukesh Ambani. So Mukesh Ambani should say, no, I'm only having 45%. So 45% of the debt only I should give my guarantee. I should not give my guarantee for 100% of the debt. So what I'm saying is many Indian companies in the 80s, 90s, they had to take significant equity because there is no other way to get, they were able to get debt capital, not equity capital. But is that the case in new generation businesses in India today? No. You take more, what is in promoter stake in Infosys? Only 11%. What are the many businesses that were built in the last 5, 10, 15 years? You will find institutions as the dominant shareholder because they participate in this company even before listing. But that was not the case in 1960s, 70s. So it is a legacy issue, but that legacy issue will run for some time. It will run one more generation. So I think it will take another, maybe when you become my seat, and probably you will find Indian shareholding pattern similar to global.
Yes, sir, I understood, sir. And the third question is, can you just elaborate the line you spoke in the video that leaders are not always large cap?
Yeah, that's very simple. IndusInd Bank is a large cap, but not a leader. Beta India is a leader, but not a large cap. Because, IIFL asset is fantastic. IIFL is a leader, but it's a small cap. It's not even mid cap. So when regulators define large, mid, small cap based on relative market capitalizations, you will find certain businesses having large capitalizations because that's what determine their presence in the business, like insurance industry. Insurance business requires capital adequacy. It requires certain size of shareholders network. It has to be large cap. You can't have a small cap insurance company. But new emerging businesses, the leader will always be small and mid cap. How do you then define leader? Leader is someone who leads by either brand which gives margin, or who leads by innovation and opening up newer geographies, newer markets. So there are certain characteristics always attached to a leader. If those characteristics exist, even if he's the largest player, he may not be a leader. So one is large cap versus leaders. Sometimes you may find in businesses, some guys are large players, but they're not leaders. They may be following the second guy. For example, slowly HDFC AMC was getting into that, right? HDFC mutual fund was the largest mutual fund 4-5 years back. But they lost leadership to whom? To State Bank. So what happened? HDFC is a leader, certainly. But suddenly in AMC game, leadership is beginning to change. Because 10 years back when mutual fund AUM was 9,60,000 crores, the mutual fund was the, HDFC was the largest mutual fund. But 46% of the mutual fund investments came from investors in Mumbai. 16% came from investors in Delhi. So 62% of mutual fund AUM came from 30 pin codes. And India has 20,000 pin codes. So city number 3, 4, 5, they were doing 12%. So 74% of mutual fund AUM came from 5 cities. And all the 5 cities, HDFC is a leader. Right? But if you take city number 31 to whole of rest of India in 2010, it was 8% of the mutual fund AUM when mutual fund AUM was 9,60,000 crores. But today, out of 39 lakh crores, almost 23% comes from city number 31 to whole of rest of India, where SBI is a leader. Right? So SBI then became a leader of AMC industry, mutual fund industry, because they were leader of the segment where the industry is explored. So leadership is defined not just by the size alone, is by usually if he has a strong brand and therefore he has a pricing power, he is considered a leader. Or he has a reach and he is a pioneer, he gets into newer product segments, newer territories, he is taking leadership position. So sometimes it happens in a large sector, consolidated sector, and therefore they are large caps. They are doing that in a fragmented sector and they're still leaders, but not necessarily large caps. Yes, ma'am.
Thank you so much, sir. I got to learn a lot from you.
Thank you.
Next, Samyak. So Samyak is a FinPlus student. Samyak, you can ask your question.
Very good evening, sir. And I am glad to be asking my set of questions before you. Sir, my first question is, in one of your interviews, you mentioned that Indian demographics and consumption play a very important role when one is analyzing the potential trends. So, since the Indian population is yet to afford the new necessities, for example, consumer durables, etc., there ought to be a very good scope for demand in such consumer durables and consumer facing companies. So in this aspect, I had two questions. First, what are the key drivers required for this consumption story to play out? And second, do you see any challenge in this consumer demand actually fructifying in future?
Yeah. It's a good question. And if we get some clarity on this question, several investment ideas will fall on us. I'm sure you might have read this book, Peter Lynch, One Up on Wall Street, Beating the Street. If you have not read, please read. When I read that book in 90s, I actually felt that these are all books which doesn't work in India. And I was right. And I used to go around many people saying that, see, these books never worked in India, where he talks about how he goes around with his wife and daughter and observe their shopping plan, making these things never work. Because I have gone around with my wife and daughter and never got it. So because the consumption market of India was very, very skewed. In fact, he even delivered a lecture when he was invited to speak to senators of US in 94 and 95 after his retirement. He didn't send the presentation beforehand. So after he came, opened his laptop, connected, showed his PowerPoint, the whole audience was shell-shocked because these were all senators, right? Average age of senators in US is 50 plus, and they were all there with their wives. And Peter Lynch, after retirement, he himself was 60 plus. So he was giving a lecture. The title of the lecture was Rent a Girl Over a Weekend. That was the title. So he was giving them lectures on how to pick stocks, how to do investment management. Basically, what he said is the best way to get an investment idea is if you have a wife or daughter, please give her $1,000. Just keep quiet and go along with them over a weekend. Observe what they're buying, how they spend life, where they see value, where most of the money goes. And that should determine you where the consumption trend is changing. And if you do these multiple weekends, you'll get a perspective of where is consistency happening, where is short-term fad giving away. So which he used to do. So all that he captured in the book. So here, I now begin to think that the time for ideas of that book is started 2-3 years back. It actually started pre-COVID. What prompted that is when people describe consumption, we always take binary in our mind. Okay, these are all haves, these are all have-nots people, these are all rich. And then we say everyone is poor. That's wrong, right? Let's look at consumption, consumer durables. What income size consumer durables come require detailed understanding. I think I have one of our product video where we spent half an hour in explaining the household structure. See, if you take our 140 crore Indians, we are on an average 4.5 people per household, so 28 crore households. And if you put them in a scale of 1 to 100, where 1 is farmer in Bihar and 100 is richest man, Mukesh Ambani. Now, you pick any consumer durables, I should be able to tell where is the market, what is the major market of buyers. For example, Rolex watch, then I will say 100 to 99 because there are only 28 lakh families you can appeal to if you are selling Rolex watch, right? If you are a diamond ring, not 100 to 99, you can go up to 100 to 86. If you're a mattress guy, 100 to 93, 27% of Indian households have branded mattresses, right? If you're a washing machine, 100 to 88. If you're a television, if you're a air conditioner, 100 to 84. If you're a television set, 100 to 26, right? 74% of India have television sets, right? If you're a projector, home screen guy, 100 to only 74. 26% of India has, it's a recent number which is mind-blogging to me. I can't believe a household which doesn't have a washing machine, but have a projector. Maybe it's a commercial use also is included here. So if we can put that number, then we will know which consumer durables to buy. Where I think most of the industry analysts are going wrong, I'll tell you 2 ways. Is when they put consumption number, when they extrapolate based on the household income, right? For example, if you're a household of 4 people and you have 25,000 rupees monthly income and you are the only salary earner. So 4 people household, one guy earns 25,000 rupees a month. How many footwear that house will have? The natural answer you will get is one set per family member, and the salary earner may have 2 sets. So 4-member household with 25,000 rupees will have 5 footwears. Now, if his income doubles to 50,000, how many footwear will be? The 5 won't go to 10. 5 will go to more than 15. Okay. Now, the 25,000 rupees stage, how many tubes of toothpaste he bought? Now that his salary has grown from 25,000 rupees a month to 50,000 a month, how many tubes of toothpaste he will buy? Same, not more, right? But if family of 4 with instead of 25,000 rupees salary, if his salary was 1 lakh and his salary becomes 2 lakhs, number of footwear at home is going to double? No. Price per footwear may go, number of footwear may not. So different consumption products have different inflection points of that income. That way it is underestimated by 99% of Indians is the role of credit and the role of women in income zone. As you know, our employment rate in India, everyone focuses on unemployment. What is unemployment rate? People who are unemployed looking for employment is unemployed. If unemployment rate is 8%, what is employment rate? That's not 100 minus 8. Employment rate of India is only 44%, which means those who are adults aged between 15 and 60, 8% of them doesn't have a job and looking for a job. That is unemployment. 43% of them work. So what about the rest? Rest are not looking for a job and they are not working. And that, if you take women labor participation rate is only 16%. So out of 100 women aged between 15 and 60, only 16 women work. 84% of the women do not work and are not looking for a job. What is the labor participation rate of men? 66. Okay. Which that 66 is closer to global average. But 16 is not. And actually, labor participation rate has declined in India in the last 5 years. But that's not what we see when we go around, right? If you take IT industry, the women labor participation, which used to be 20%, is now 34%. Banking and financial services industry, which used to be 14, 15, is already 40%. Right? But the women labor participation has declined because the rural women labor participation in poor jobs, poorly paid jobs, have declined. Urban women labor participation. So labor participation rate as a whole for women has declined for 2 reasons. One, their GVA, gross value added, has gone up, but they are pursuing higher education. How many of us notice the fact that there are 59 lakh people who graduate out of colleges a year? 14 lakh postgraduates, 45 lakh undergraduates, 60,000 doctors. And the number of graduates we produced the last 10 years is more than 1947 till 2010. Okay, what we have produced. And more than half of them, almost 55% of them are women. And if you put in a scale of 1 to 100, and if you ask now, which quintile, if you split this 1 to 100 into 5 quintiles of 20% each, which quintile has highest number of graduates? Everyone will pick 80 to 100, right? But the real answer is 60 to 80. Right? 60 to 80 has more women graduates coming out, which is pushing down the salary costs dramatically. And TCS, 80% of the people's salary cost last year was same as 10 years back. Did we notice? When I ask this as a question, what do you think is the average salary of State Bank of India? This is IIM second year MBA students question. And many people come with many answers. Can you take a guess? Take State Bank of India annual report, total salary expense, chairman, managing director, branch manager, zonal DGM, to the driver in the branch. Total salary expense divided by total number of employees. What do you think is the annual salary cost per person, per capita annual income? Just take a guess.
50,000 around per month would be 50,000. Per annum would be around 6 to 10 lakhs, 6 to 10 lakhs bracket, broad bracket.
Okay, any other guess?
On a higher end, 12 lakh, not more than that, right?
Any other guess? Boss, you all haven't come halfway through. It's 21 lakhs.
What?
21 lakhs. So State Bank of India has 2,50,000 employees and 53,000 crore salary cost. Okay, it's 21 lakhs average. Okay, ICICI Bank has only 1 lakh employees and it has same market cap, similar business, extremely productive, 1 lakh employees. What do you think is the average salary cost of ICICI Bank?
6 to 8 lakhs.
Hmm?
6 to 10 6 to 10 lakhs broad back.
Take another guess.
Around 15 to 20 lakh per annum.
Okay, one more guess.
25 to 30 lakhs.
The real answer is 7,80,000. Okay, similar sized bank, 40% less people, but not even half the salary. At 40% less people. The reason is ICICI Bank salary is a function of demand and supply. Supply of talent is so high, salary hasn't gone up. What is the entry level salary cost of ICICI Bank 2008 and 18? Not inflation adjusted, actual appointment salary that you see. Same in 2008, same in 2018. But in the same time period, State Bank of India salaries have doubled because it is going up along with 3% DA each year, each pay commission, each central. Because there it's not demand supply, it's based on inflation adjustment. So if you take say top, okay, this is not just to bank alone. Take top 5 IT companies: Infosys, Wipro, TCS, Cognizant, HCL. These are all 5 large employers of India. How much is the salary cost gone up between 2010 and 20? Average salary. Here I'm including chairman, managing director, every global CEO to the entry guy. So how much you think the salary growth of top 5 IT companies between 2010 and let's say if the 2010 salary was 10 lakhs per annum, how much it has gone to 2020 over 10 years? What percentage per annum? During this 10 years period, shareholders' return has grown between 18-20% per annum, which means market caps have quadrupled.
Per
Take a
annum could
guess.
be in the range of 10 to 15% per annum or normal growth rate per annum, salary growth rate.
Any other guess? So the actual growth is not even 3% per annum. But the impression we get that most of these senior guys, CEOs, salaries have grown. We use a number in some of these companies called T10B50. We take the top 10 employees, we take the bottom 50 employees, and what factor they are moving from. If that factor is 20 or 25 times, then it is normal. That's India, which is very not normal globally, but it's okay in India. But companies, there are companies which goes to 100, right? Which are all highly unequal, right? 50% of the employees in the company earn not even 10% of what the top 10 employees earn. Gives you sense of inequality. So what I'm saying is, why is it low? Why Indian IT company salaries have grown only 3% per annum when the revenues have grown 15%, shareholder returns have grown 20%. So these companies should not have had a problem paying more. But then why they paid 3% for people is supply of people is high. How many engineering graduates come out of India? Close to 20-25 lakhs a year. How many people IT industry takes each year? 7 lakh people a year. That's it. The total IT employees in India is only 48 lakh people. So when you have supply, so what I'm trying to say is, it is the 60 to 80 which is creating that supply, and the demand, when consumer demand comes from that 60 to 80, you will find numbers growing mind. That is why number of air conditioners sold in India last 5 years is more than what got sold in the previous 20 years. That's not a sign of slowdown, right? But number of toothpaste sold in India last 5 years is same as the previous 5 years. Income has grown, but that product has grown only 1.5% per annum because it is growing in line with demography, population. But footwear industry is growing 10 times of that because most of the population is coming. So probably 3 years, 5 years from now, you will have different product where you will find different. That is one. Second is the role of credit is playing a big role in many of the consumer durables. It is not availability of credit. Availability of credit existed 5 years back also when we had so many NBFCs. The attitude to credit is changing. If you are a 29-year-old home buyer in 2021, your attitude to credit is different than a 44-year-old home buyer of 2001, which is India's average. Can you believe? India's average age of a home buyer in 2001 was 44, which means most of these guys were born in 1950s. They worked 20 years to save enough money and they borrowed. And if you take the last 20 years, all the home loans taken in India, average tenure is 15 to 20 years, but 80% of the home loans were closed before year 8. 50% of the home loans are closed before year 6. That's what that 44-year-old guy will do, right? But the 20-year-old home buyer of 2021, he was born only in 90s. They are all children of post-liberalization. So when they buy a house, they buy 3 air conditioners all on EMI. So 31% of air conditioners sold on India last year was on EMI. And the number of air conditioners sold on EMI last year was more than the entire air conditioner industry of 2014. So credit can double the industry in few years. So these two are the ones which gives us enough confidence. We should be in consumption side, but we should be in the kind of consumption where you mentally put Indian consumers in a scale of 1 to 100, then ask, are they 100 to 90 going to become 100 to 80, which means the industry is going to explode. Which means everything you should start with 100. And if it is your mattress where 100 to 93 is going to become 100 to 85, then you should tick the box. If it is a product which is 100 to 74 and it's not going to, because I think in India making money on premiumization is a lot less possible than making money on penetration. So everyone has the S curve, right? So many of these toothpaste companies were in the growth phase of the S curve in 1980s, 90s. So today they are mature. Hindustan Lever is the only company with multiple S curves in multiple products. They invest in several products before their existing products get into maturity phase. But if you are investing in single consumer durable, single product company, you should ask the question which leg of the S curve you are investing in. And if you get someone in the lower end of small growth, about to get into high growth, which is what air conditioner was in 5 years back. Voltas has sold more air conditioner last 5 years than what they sold ever since they came into the AC industry. So therefore, best time to buy that was 5 years back. Maybe now, because they're halfway through that boom. They're nowhere near. So we should not talk about consumption boom and go and buy Colgate. Yes, sir. It's a lengthy answer.
Sorry, Samyak, I have one follow-up question here. So let's say you've identified these kind of products, these kind of businesses, and let's say there are 2-3 listed players in the same. So how do you go about, attributing that possible growth on these players, or maybe, follow a diversified approach, maybe invest in both of them and see how it pans out?
Yeah, it's a good question. I think this is most underrated skill in India. Everyone talks about macro, industry, opportunity, but goof up on stock selection, because the execution skill set in India is one of the most underrated one, which just merely meeting the promoter doesn't help. You should observe what he has done towards that. Does he have the ecosystem? Does he have the execution skill set? Does he also share the same beliefs, same excitement that we have? And that execution skill set is hard to crack. And it comes with experience. It comes by asking right questions, right? So you are right. You can be correct with your observation of the opportunity. For example, if someone came and told you that in the next 5 years, the share prices are going to double, which it did. If someone had come and told you in 2016 that Sensex will go 80%, small mid caps will go 100%, which means share prices in general are up 100%. And the number of shares traded in the market will double, which means the turnover will quadruple. NSE's own valuation will quadruple. And then you go and buy out of the top 5 brokers, 2 brokers, which is Motilal and Edelweiss. What you just did is excellent analysis and poor stock picking. It will be down minus 50. At the same time, had you bought ICC Securities, you would have done 300%. Had you bought Zerodha, which was a private company, you would have done maybe 10 times. So same industry. On the other hand, if I come and told you 4 years back that see gold jewelry industry is shrinking and 70% of the gold jewelry are bought by people who are in 20s and 30s and 40s. And today, India, 2/3 of India is aged below 34, and half of them are women. But women in 20s, 30s are not buying as much jewelry as the previous generation bought. And therefore, total gold jewelry retailed in India between 2016 and 21 is going to be 20% lower than 2011 and 16. Okay, industry is going to shrink 20% in the next 5 years. And if someone had come and told you, and then you went and sold the Tanishq in these 5 years have done 3.5 times, 340% higher revenue than what they did in the previous 5 years. So what they did is, in a shrinking market, they gained market share. That's execution skill set, and extremely on the opposite side. So what you should do is, when you do top-down view, and the only way you can choose which company I should buy within that space is by evaluating the execution skill set of the management, nothing else. Rest of the stuff are important, but this is like a multiplier of 0. If this is 0, whatever other skill set you have, you multiply, you get 0. This is very important.
Thank you so much, sir. Samyak, please move forward.
Thank you, sir. So from your answer, I understood that just plain analysis that consumption is growing, it won't lead to plain increase in demand for all the goods across the basket. We have to segregate each and every strata of the industry to justify that which is going to lead the growth. Thank you, sir, for that answer. My second question is regarding that historically, the chances of growing wrong is more in small or mid caps versus the large caps. So how do you manage the portfolio level risks by investing majorly in such small and mid cap companies? Any key research parameter that you look for while investing in such companies?
Actually, you're optically right. When you go wrong for different reasons. One is governance related reason. Second is information asymmetry related reason. If it is governance related reason, it is not that corporate governance is poor in small cap, great in large caps. Actually, there are only 100 large caps, but there are 250 small caps. So in absolute terms, even if 2.5 times higher number of small caps have poor governance issue, it's uniform, it's same, because the base is larger. But the challenge is not corporate governance. The challenge is information asymmetry. If something goes wrong in large caps, all of us come to know same time. But if something goes wrong in small mid caps, by the time we come to know, it's too late. So in biology, they call this as food chain, right? Which part of the food chain that you are. So in that information chain, you should judge which part of the information chain you are. In that information chain, if you think you are in somewhere near the last, you should not play small cap game. But if you think you are in somewhere in the tier 1, not because you know the promoter, but because you know where to look for information, You have the ecosystem to validate. You know their customers, vendors, suppliers, their electricity bill reading. That will, if you are nearer to the top, you still can go wrong. Your assessment of business may be wrong. Your assessment of the promoter's future execution skill set could be wrong. But information asymmetry is not a risk to you. Business risk exists in large cap, mid cap, small cap. But information asymmetry is extra risk you take in smaller companies, which is not a risk, which is a risk if you are in the information chain, if you are in the bottom, not so much in the peak. But otherwise, I don't think governance has anything to do with scale of the company. I can give you hundreds of small caps with the top class governance standards than hundreds of large caps. Yes, sir. So maybe in interest of time, can you pick one per person, one important question that you look, and then we can address those few questions at greater length. Would that be a good idea?
Surely, sir. Surely, sir. So, Samyak, maybe you can ask one last question at your end, whichever you feel.
Sure, sir. I would take the last one. Sir, I have seen your multiple interviews, and from the interaction that currently we are having, and it's very evident that the data crunching, what is involved in analysis, and how you correlate multiple data points to form a conclusive opinion, it's very evident from your analysis perspective. So what I wanted to understand is, when we are selecting companies, and when we are selecting companies, do you track data points for each and every qualitative factor which is available in your list to justify whether to enter in that theme or not?
Actually,
Wanted to
the
just
data
broadly
points that
understand.
we use, the data points that we use mostly for carving out those pockets of market to scout for opportunities. But we do not take the data points beyond that. Its usage stops at that. It's like leaving the footwear outside the main gate. Once you come in inside, you need to walk differently, right? With food. The reason is, when you let your excitement of the broader data points to influence your individual stock picking, what if the governance is not great? What if the balance sheet has debt? What if the promoters are fighting? What if there are so many things that can go wrong? So the data point should say, okay, India is growing today, the demographics of this type, urbanization is happening, and this is consumer durables is a segment that we should be in. But within that, why not I look at this Dixon Technologies instead of something else? It should not be that data. That is why I don't get into stock picking. So I actually do not do individual stock picking in Unify. We have fund managers, we have analysts, and many of these analysts may not use my data points beyond certain extent. Something else should be driving. Data selection, see, there are only two things which will determine your return as a shareholder, right? Earnings growth of the company and the price you pay for it. What are the data you need to judge the earnings growth of the company, which means your top line growth, how much of the top line growth coming from price and volume, and then margins, which means what is going to drive the margins. That will then take you to your customers, vendors, suppliers, as well as your competition. That in turn will take you to, so every company we look, sometimes our worksheets go to 100, 120 worksheets. Some businesses we don't require more than 10, 15 worksheets. And we need to see the sensitivity of the worksheet. We are okay with volatility, like our investors. Our investors are okay with volatility. What they don't like is shock, surprise. If we put that worksheet and I have a 20-30% sensitivity, and that 20-30% sensitivity is occurring on the negative side, I'm not going to be surprised or shocked, and I'm not going to sell. But if I have one precise number as target, and anything outside that number is something which is going to be shocked, then I will be a poor investor. So to answer your question, the data points are important in helping us. It's like a screener. It tells you these are all the names you should look at. But what you should buy in that is what drives earnings and what price you pay for. Nothing else. Their data don't help. Yes, sir. Thank you.
Understood. Thanks a lot, sir, for your detailed answer. Thank you very much.
Preet, maybe you can ask your question. One question. Any one of the
sir.
three.
Good evening, sir.
Hi, Denny.
Sir, basically, I want to ask that some companies management takes loan and then pays dividend. So, sir, so that they think that market will give high valuation if stable dividend is given, and when market cap increase. Sir, but on the other hand, people also say that management should not take decision keeping the stock price in mind, and they should focus on long-term operations of business. So as an investor, while analyzing that management of that company, should we judge that the decision of management was fruitful, or they are just trying to keep the valuations in high zone?
Certain decisions are not really black and white. In certain context, what you take as a decision may be right. In different contexts, it may be wrong. For example, if you come Chennai and you marry your elder sister's daughter, it is a good custom. But if you go north and if you marry your elder sister's daughter, it's considered bad. How can you marry your own sister's daughter? But in Chennai, that's a custom. You know? My elder sister's daughter is how I should marry. So there are different contexts to be seen. But leveraging to pay shareholders is a bad business idea. It can give you an illusion, but illusion is certain limited time period. That is what most, see, Lehman Brothers leveraged and did a buyback 8 months before going default. Did it help? It didn't. So leveraging in the last 10 years, $4 trillion of debt listed companies have taken in euros to do buybacks. So when you leverage and do buyback, what are you doing? You are increasing the liability, you are reducing the equity, right? The per share earnings are going to grow. Let's say I run a business and my equity is 10 rupees and my per share earnings is $2. But if I take 1% loan, 10-year debt, right? My earnings yield is 10%. My PE is 10. But I take 1% debt for 10 years and do buyback 20% of the equity. All else being equal, my per share earnings have gone up 20%. Because my debt is only 1. But next year, all else being equal, I take another 20% debt and I buy back another 20% of the equity. When my earnings yield was 10. So what will be the earnings yield of the residual shareholders? You will go further 20%. But is it a continuously good idea? No, it works short term, but it puts the business to a greater risk should a volatility come. Because should a volatility come and you want to reverse, which means you want to pay back, and you want to raise equity, can you do that? We can't. So to answer your question, this may be a good idea to keep 1 year illusion, but a terrible idea if you're a long-term investor. Yeah. Yes.
Thank you, sir. Thank you.
Dhruv, maybe you can ask your question.
Sure.
So Dhruv is our Finbridge student, and so was Preet.
Excellent. Thank you.
Good evening, sir. Sir, I've come across very few people who back their narratives with data, and you are one of them, sir. And so I like your videos a lot. Sir, I just wanted to know your views on industries where competition is on price. So how do you detect changes in dynamics of such industries? like how price wars happened in telecom between Airtel, Vodafone, and your Geo. So then these dynamics started changing, and then recently we saw the prices going up. So how do you see this dynamics changing?
It's tough because again, there is no one right wrong answer here. Let's say you run a finance company and you have price war. Your cost of capital is 8% and you lend 12%. You incur 4% gross interest margin. You have 1-2% cost, 2% net interest margin. Your life is simple, happy.
Yes.
But someone comes and gives you price war. Instead of 12%, he is willing to lend at 11%. Someone comes and says, I will lend you at 6%. So what you can do, you can choose to keep your rate at 12.
I also have to come down.
Or you may have to come down. You can still choose your rate at 12. Many people will not deal with you. But some people who knows that 6 is not sustainable will come to you, will stay with you. Your business will come down, but you will stay. And if you choose not to lend, you are not going to go bankrupt. You will still be around. But the guys whose cost is 8, who's lending at 6, who's DD, next year his cost is going to go. But his logic is, if he makes you to bleed, but if he has access to capital, after you leave the industry, he can increase the price. That's called predatory pricing. Predatory pricing, regulators get in saying that, boss, this is not fair. You can't do. But in India, it happens in different form and manner in different businesses. Telecom, it is so obvious and apparent. But it happens in several businesses. At that time, the character will determine what. For example, one of our large holding was Muthoot Finance at that time for many years. If you look at 2014 to 2018, in those 5 years, the same Motilal, Edelweiss, these are all guys who built their own NBFC business. And they also came to Gold Finance, IIFL Gold Finance, all this came. And you had peer groups like Manappuram. What is the AUM growth of the industry in that 4 years? Bajaj Finance grew 40% per annum, AUM, between 2014 and 18. What is the AUM growth rate of Muthoot? 5% per annum. That's it. They were the slowest growing finance company for 4 years in a row. 4 years in a row, you were the slowest growing. So what happened in those 4 years, gold prices did not move. So government, RBI, which earlier allowed only 60% of the gold to be given as loan, they increased to 70%. Then once many banks exhausted, they said, okay, it is now increased to 80%. For PSU banks, up to 90%. You can lend. Right? And then people said, you can lend multiple years. So what Muthoot did, they said, if I go and lend 80%, because my cost of borrowing is only 6-7, it is falling, but my loan ticket sizes are small. They have 94 lakh customers, 35,000 ticket size. So my cost of delivery of loan is higher. So I don't want to reduce my rates anything lower than 14, 15. But banks were giving a 9. He didn't reduce below 14, 15. His business growth took a hit. So if you are a gold loan buyer and if bank is giving at 9.5 and Muthoot is charging 14 and doesn't want to reduce. So what will you do? You will shift out. Okay. But if you're a 40,000 rupees loan buyer, why are you borrowing 40,000? Not because you want to borrow 40,000, maybe because you can borrow only 40,000. How much you can borrow is a function of how much gold you have, and how much the lender is willing to lend. So some borrowers may go to a lender who lends most amount of gold for the same gold value. I had 10 grams of gold. Each gram is 5,000 rupees. 10 grams is 50,000. But PSU bank says, I will lend you 45,000. Muthoot says, I will lend you only 30,000. So what will happen? The desperate borrowers will move to
the
those who
PSU.
give the highest loan for the same gold. So Muthoot could not grow. Then September 2018 happened. ILFS defaulted. Mutual funds shut the door for all NBFCs. All NBFCs were borrowing short-term money from mutual funds and doing all the long-term loans. So they all got trapped. So Edelweiss announced in October 2018, we want to reduce the book size. Not voluntarily, you had to, because you have to pay back. But your borrowers are not going to pay back. So they were selling their loan book. What yield they were selling the loan book? 14%. Why? Muthoot said, I will buy only 14%. 1/3 of Muthoot Finance book was FD loans. Raising money of FD, everyone felt is inferior way of raising money because it's high cost. A, you have to pay higher interest rate. 2, everyone will come to office. You have to have an office application form filling up. But if you borrow from mutual funds, many mutual funds are getting so much money, they are willing to lend. Templeton was no due diligence. They were willing to lend. So, but Muthoot still made it. What I'm saying is, when people come for competition, if you're in a business where you can stay till madness goes, that price competition is not. It's at best it's going to have an impact for some time, but that's the best time to buy. That was our largest. We went to the maximum level that we could go within the limitations we had. But if you are in a business like telecom, where you don't have that luxury, saying that everyone will reduce the rate to 1 rupee, but I will still charge 4 rupees. No one is going to be there. Such businesses, which is extremely price sensitive and you don't have pricing edge, you should not be a shareholder in this business. You should accept that as a bad fate and walk away.
Got it, sir. Thank you so much for your detailed answer on this part. Thank you so much.
Thank you.
So moving to last 3 questions. Akash, you can ask one.
Sir, good evening, and it's my pleasure to learn from you. Sir, my question is regarding like tech companies. They are very data-rich companies, and they are willing to sell this data to the biggest or bidder in the market, the consumer data. So, do we see such data vending companies which will sell consumer data? And if yes, then how will we value these companies, as data is a very subjective thing? So how will we see growth or revenue in such companies? Because we cannot value these companies.
No, yeah, it's completely outside our competence, our competence. I haven't done enough work in that to understand. I'm also as confused or as unclear like you, and there's no one in Unify trying to make any sense out of how do we put valuations. About 5-6 years back, when one of the IT company demerged its product business, globally, product companies in certain platforms are trading at 6 times, 7 times, 8 times sales. And in India, this company was trading almost 1 time sales, like any other business. But we didn't jump and buy. We spent 3 months, 6 months, 1 year. And the reason why we could spend longer time is because no one is tracking those companies. And they were not pressured to move. Because there are only 3-4 such companies in India. And if you see, when analysts do a work, whenever a new business comes in, when analysts begin to do a work, he will try to see, I'm going to put anyway so much time. And if all this time can be used in analyzing 10 companies within that sector, he'll be happy to do it. If all his analysis is going to be used to evaluate one company or two companies, he will hesitate a lot before beginning, because in India, the cost of analysis is inversely proportional to the size of the opportunity. And what opportunity you mentioned, if the size of opportunity is large, then cost will be low. By now, many analysts would have done. And the reason it's not done is the cost of opportunity. Maybe if there are too many names in this universe, someone would have begun to do it. But to give you a candid answer from outside, maybe I'm not equipped to answer that question. Maybe if we get more skill sets or people within our team who have adequate skill sets to evaluate that business, we should be able to do. But fact is, we haven't done yet. Sorry.
That also, I think, but one good thing came out of that was, if it is out of your circle of competence, maybe you should ignore it and focus on something which is in your circle of competence.
Even if it is Tata Elxsi.
Yes, definitely. Thank you, sir, for that. Parth, we can move ahead with your question.
Yeah. So very good evening and good to have you here, sir. So my question is, how do you manage, how did you manage the down period? The pre-COVID levels where we saw 2018 IL&FS crisis, which gave an heir to NBFC crisis as well. And there was a liquidity crunch. And earlier also in the start of the session, you mentioned that the SEBI giving a cap on small caps and investing mutual funds. And immediately after that, it was followed by COVID. And as a fund manager, so how did you manage the impulsive nature of the clients and the patients associated with that cooling period? And how difficult and challenging it was at that point of time for you to sustain the clients and to get on more funds? So I just wanted to know the strategy and what was the mental model behind dealing with those tough times. Thank you, sir.
Yeah. So between 2010 and 20, if you take all the capital we raised, the year where we raised the largest money was 2018. And the year where we deployed 100% of the money in small mid caps was 2018. With benefit of hindsight, now we know it was a wonderful decision. The reason we could do that is in 2016 November, we closed our best performing fund and returned the money. And in 2017 January, we told our investors we are closing subscription in all our things. So if you show character and resist the urge not to accept capital in a peak, you should be able to confidently stand before the investor in the bottom. But if you play the game in the whole market cycle, you have to undergo that pain in the bottom cycle. If you raise money in the peak, you would have had some sound reasons to raise money in the peak, right? So if you keep the scheme open 365 days a year and accept capital throughout the year, and therefore it is up to the investor to decide when to invest and when to redeem. Why should you be upset when he redeems, when he can't take the pressure? But if you think it is wrong on his part not to redeem in a market fall, then it was also wrong on your part not to accept his money when it was peak. That's one. Second, fund managers love freedom. They want wider canvas. They should, when they like an idea, they should be willing to move. But when they sell, they want to sell a subjective idea, which is why if IT industry do well, you find a lot of IT funds. But after IT became out of fashion, I saw guys holding Colgate in a IT fund, saying, no, 25% we want to diversify. But why did you sell in the first place as an IT fund? If you think IT is not a good place to be, why don't you return the money back to the investor and then take a money calling it as generic equity fund? So when you sell in a thematic manner, you get the right type of capital. That's the advantage. We made the mistake. We learn from the mistakes. So when we do thematic funds, for example, when I go and do a fund called Insider Shadow Fund, where I buy only those companies where promoters increase stake. Today, if you take top 200 promoters, maybe 41 promoters, 41 promoters maybe already knows this fund and had some kind of engagement investment. Because I have to go and explain to him the merit of investing in this theme. Because he is himself doing creeping acquisition of his stock. So I go and tell him, boss, you are doing in your stock, like you are doing in your stock. So many promoters are doing in their stock. Why don't you put portion of the money in their ideas based on that? But how do I explain this to a foreigner? He doesn't know insider. In his market, promoters are holding only 6.5%. And promoters are not contrarians in US, whereas in India, they are contrarians. So if I go and take money from wealthy NRI in US and in insider shadow fund, and my fund is down in a rising market, what will he say? Because last time we did insider shadow, 2012-13, our first year return was lower than small cap index, mid cap index, large cap index, any index you take, we were lower. Because in 2013, we were buying commodities, sugar, textile, and none of those businesses did well for a year or two. But in 2017, even now in our client communications, we have the audio. The same clients were upset with us that we were selling, we were closing that fund. We had 1.5 years more in that team, but we closed the fund, sold the stocks, returned the money back to the investors. And that particular year when we sold, that year return was 72%. And because all of that came in short term, and those days short-term tax was existent and long-term capital gains was free. And clients were agitating, saying that, boss, had you just waited 2 months, it would have become long-term. I would have saved all the taxes. See, because you sold, we have to pay them. We said, boss, we are not looking at tax to take a decision. If I'm shadowing insiders, and insiders are the biggest sellers in market, what do you want me to do? Right? In 2012, I sought money from you saying that I'm going to shadow insiders, but now insiders are selling. So I should sell. So the reason why I'm saying is, on that fund, if I go and buy a company where promoters are selling, I'm digressing. So that's what resulted in credibility gap in markets. So if you build credibility and walk the talk, you can handle the investors better. But you can't handle all investors all the time. So we ourselves felt handling, say, certain investors, they all have inflection point. No? We all think water boils at 100 degrees, it freezes at 0 degree. I can show you several people who will freeze at 30 degree also. There are people who won't boil even at 100 degree. Right? There are several human beings, right? So if Chennai temperature goes below 24, you will find people putting mufflers. In Chennai, 24 is like 0. Right? Whereas people in Delhi, even at 10, they go out and have ice cream. So different people have different inflection points. My clients, they can tolerate 6 months, 1 year underperformance. Some people will jerk out at 18. Some people will be okay to handle for 2 years, but not longer. So I think, fortunately, our pain in 2019 didn't continue beyond 20. But one should be prepared at least for one. 58% of investors in India redeem before year 2 if it is negative. That's the data point from mutual funds. 58% of investors in India redeem before second year if the NAV is negative. And that's a clue saying that if you think markets are falling, you should not raise money when it begins to fall. You should raise money maybe 6 months to 1.5 years after it falls. So that when you raise money, you at least have 2 years time to handhold the investors till it comes back. Yeah.
Very nice. Thank you, sir.
So last question from our side. So like we talked about a lot of macro factors, and a bit of micro analysis. My question is, how much time and efforts should ideally one should place on the macro story and then dig deeper into the micro story? Because like you said, there is always an opportunity cost, and the time taken for the analysis depends on the opportunity size as well, inversely proportionate. But in terms of macro versus micro story, how much percentage efforts or time should one put in macro as compared to micro, in your experience or in your opinion?
Macro should be used more as eliminator of businesses. Micro should be used as the ideal tool in selecting the ones to invest. You should have a strong reason not to invest in a sector because of macro reason. But you will never have a strong reason to buy a business because of micro. Therefore, maybe I don't know how to put a number, but if you look closely, most successful investors who really build genuine wealth, they talk macro, but ask them. Warren Buffett many times have said, if a Fed governor comes and whispers in my ear the interest rate for the next 4 meetings, my portfolio is not going to change. So for him, macro is less important. But he will also talk macro, but he is not going to let macro to determine what he's going to buy. He's going to let micro to determine what he's going to buy. But his understanding of macro will tell boss, I'm not going to get into any of the banks in 2006 or 7 or 8. So macro should be used more as a shield in making blunders, in avoiding pitfalls. And if there will never be black and white. There will be some areas of gray in macro. If it is gray and you don't mind missing an opportunity, you avoid it. That's the advantage you and me have. A fund manager doesn't have. If I'm a benchmarked fund manager, like a mutual fund, I have to explain what I hold, and I have to rationalize why I don't hold certain things. If I don't hold Reliance, I have to explain why I don't hold Reliance. If I am not a benchmarked fund manager, or if I'm a direct equity investor, I don't have to explain to anyone that why I don't hold Reliance. I have to explain what I hold. If I don't hold Tata Elxsi and stock goes up, I may have to explain. But if I'm HDFC equity fund or a top 200 fund, and my benchmark is Nifty 50, and 10% of index is Reliance, and I don't hold Reliance, I have to explain. Because you are underperformed, you are valued in relative basis. And if you are not underperforming because you do not hold banks, you have to explain. So what I'm saying is, in macros, when you have certain ideas and you choose to not to invest or avoid, and you are wrong, it's okay. No one, you don't have to explain to anyone why you choose to avoid that sector. Because you are not 100% sure, but you are not confident of staying in that sector. It's okay. So what I'm saying is, macro time, it will be, lot of time will go into macro, maybe 5 to 10% of the time. A lot of time will go to macro. But 90% of the time, your money, your attention should be on macro. It's not that 10% each day should be for macro. maybe out of 200 working days, 5 days, 10 days, a lot of time will go into macro. But balance 190 days, a lot of time should go into macro.
Got it, sir. So thank you so much. I know we are way overdue the time slot. So genuinely, a simple, quick thank you won't be enough, to be honest, to express our gratitude for you.
No,
To
I'm
take
so
out
sorry. This has been pending for a long time.
No,
And each weekend comes, I used to think maybe next weekend we should.
no, sir, but honestly speaking, like I've been in touch with Jinal ma'am, and the schedule which she had told me, I was simply amazed that you were able to squeeze in a slot for all of us at such short notice in that domain. So we were genuinely thankful for taking time out, and the quality of answers which we were expecting has truly blown the content which this session has carried for us. So we will quickly note down, after taking a look at recording once again, we'll quickly note down, the key pointers, and we'll put it off for the non-participants. So just a vote of thanks from our side for taking out time. And, all of us are very, I am running out of words. I literally am running out of words. I have no words to thank you enough, sir. So just one last thing, I'll quickly press print screen to take a pic for as a quick memory. I'll stop recording first.